Hello traders, this is Blake Morrow and you are listening to the ForexAnalytix week ahead video for August 27th, 2017, and I want to welcome you to today's video. But before I get started, I want to make sure that I do tell you that you can try our system, you can try our analysis platform for only $1. It's 10 days. All you have to do is click this button right here. It says sign up today. And you can see this system and you can see all of our analysis and you can get it all real time and you can get notifications on your mobile device. All you have to do is download the mobile app from the iTunes store or the Google Play Store, depending on your mobile device that you have, and you're good to go. All right, so let's get started with today's or this weekend's analysis, and let's talk a little bit about last week. Last week was a pretty slow week as everybody was waiting for everybody's waiting for the Jackson Hole Symposium, and then on Friday, as Mario Draghi didn't really mention anything regarding the ECB. The euro was allowed to actually finally move, and you can see the euro actually pressed higher to new highs. We hit 161% extension right there at we closed right at it at 119, basically 119.15, 119.20, and that's the 161% extension, or the golden fib of the Fibonacci ratio, for those of you that don't know, of the election night highs to the lows following the election night. But that was basically the inauguration of Donald Trump. We hit a low in the euro or a high in the dollar, and the dollar has really been under pressure since the new president has taken office, and we have actually hit that golden ratio again. Now, the scary thing is that we actually closed at and slightly above those previous highs. Now, that brings up a couple issues. The first issue is you'll notice that if you're looking at the euro dollar, the relative strength is very divergent. We hit a high in relative strength when we peaked at that 161% extension the first time around, just early in this month, the end of last month. More importantly, it's actually divergent now. So that means that as we press higher, it's moving higher on less strength. And you can see, if you go to the weekly chart, we're also previous support, okay, from back in 2010, this August of 2010, we are pressing that level once again. That's a previous support acting as current resistance. Relative strength is really overbought here. You can see how it's extremely overbought, divergent on both the daily and the weekly time frames. Now, being divergent, for those of you that remember, some of the yen pairs moving higher in the mid 2000s, they were moving higher. It didn't matter what relative strength was doing. Actually, I take that back. That was when we really started moving higher, when relative strength was diverging in the yen pairs. Happened to be like the dollar yen, happened to be when the when Abe did the three arrow approach, I believe is what he called it at the time. And when that happened, it didn't matter what relative strength was doing. The dollar yen continued to press higher from 82 yen towards 115 yen per dollar, and so the euro could be doing the exact same thing. But that doesn't mean that you can't get hurt chasing this move higher, and that's the thing that I want to caution you about. Is I think this type of move, you have to be a buyer of dips. Now that's easy to say when that's easy to say right now, but the question is, when will there be a dip, and when will there be a pullback? Will we hit 120 first? Will we hit 121 before we see any type of significant pullback? I don't know, but I will tell you this: I'm not shorting the euro dollar either. It is very strong. Any dip now back towards 118, this trend line support is going to be bought pretty aggressively, even if we do a false breakout. At this point in time, the pullbacks are very shallow. That is typical of a very strong trend. And so when the euro dollar is just continuing to press higher, it's not giving anybody any opportunity to cover shorts, and it's not giving anybody opportunities to get long. That is a pure definition of a very strong trend. So even though it is divergent on relative strength, even though we are at a key fib level, at that golden fib level. That doesn't mean you should be shorting it necessarily. We should be buying on dips, but again, the question is, when will we have a dip? So that leads us to this week. Now, we are in the last real week of poor liquidity for summer, but we do have a busy week. We have non-farm payroll this week. Okay, so that's important because along with non-farm payroll, we have private ADP jobs report, which comes in on Wednesday. We have also preliminary GDP that happens to just fall on this Wednesday as well. We will have PMIs. Actually, the PMI that we're going to get, manufacturing PMI, we're going to get on Friday, on the 1st, but we'll get services PMI the following week. But we will have non-farm payrolls, and that might give us an opportunity for the dollar to bounce. It's hard to see or see a reason why the dollar will bounce between now and then, though, or now and Wednesday. So we might see some dollar continuation lower as we start the week. And you don't have to trade the euro to the short side. That's not the only option you have. If you look around and you look at like the cable, for example, the pound, it may have bounced on Friday, and we bounced at a 38% retracement. That's from the trend lows of this year to the highs, just this last month or just this month. We've pulled back to the 38% retracement, but we might bounce for a day or two, but this might be a pair that would give you a better opportunity to be long dollars if the dollar is to bounce. Also, you could take a look at, like, let's say the Kiwi dollar. Kiwi dollar is a great example of, in the event that the dollar does have some sort of recovery. I mean, you look at the Kiwi, we have a nice head and shoulder set up here. We have the head, shoulder, shoulder, and we're basically on the neckline. We might bounce for a day or two, maybe back to 73 cents going into the beginning of this week, but we could roll over there. There's another potential that I'm looking at in particular, and I'm going to take you over to the US dollar Canadian. Now, the reason why I'm going to take you over to the US dollar Canadian is you'll notice the dollar Canadian has not hit a new trend low. It probably will this week. Monday, maybe Tuesday, we might actually hit a new low and break through 124. But before you get too short, take a look at the weekly chart. And you'll notice this trend line support coming in at 124, or excuse me, 120, 123, 20, 123 and a quarter. This is where the 127% extension is. And matter of fact, let me take you over to the dollar Canadian so I can zoom. I got to zoom out just a little bit further. The candles get a little scrunched up when I do this. That's why I didn't do it for the weekend analysis, but you'll see this trend line that comes through here, and that's going to come in right at 123 and a half. If I'm going to play the dollar bounce again, I'm looking at other opportunities rather than shorting the euro. Now, you could always say, well, maybe I might buy the euro Canadian, or I might buy the euro Aussie. Those are other opportunities as well. But the dollar Canadian, for example, is one currency that if I do choose to play dollar strength later on this week, this might be a currency pair that I actually target. Now, one last currency pair I want to bring to your attention, this has been a very organic trade. Let me find it really quick. There it is the Aussie New Zealand. And I say organic because there hasn't been a whole lot of data pushing us up towards this resistance, but take a look at this cup and handle pattern, or you could say it's an inverted head and shoulder pattern, whatever you want to look at it, or however you want to look at it. The fact of the matter is we are pressing a major resistance. Take a look at the weekly chart. Now, we have a low that was hit back in 2011. And it's a trend line that comes all the way through, and you can see these highs that in 2015, the highs in 2016, the highs in 2017 thus far come in right around the same price. Now we are up against major resistance. You could play it two ways. One way is you could short it here and put in a really tight stop, which makes sense. I mean, if you want to short it here and look for a move back down to 108 or 109 or 108.50, that's possible. Or the other thing is if we do break out and we break out towards 110, this could be a massive move. Looking this week, there's not a whole lot of data that's going to press the Aussie New Zealand into new highs, but we do have Australian capex or private capital expenditures that will be released on Wednesday evening. It'll be early Thursday morning for Australia. That could be a catalyst that breaks us out. So maybe between now and then it might pull back a little bit, but that might be the reason that we actually break higher. Or, that could be the catalyst that completely drives us right back into the middle of this triangle. I mean, we could be still developing the apex of this wedge, but it is a big wedge that's been in development for a couple of years, and I think a breakout is looming. And you guys know, for those of you that listen daily and you follow me in my analysis, I am very in tune with the Aussie New Zealand, and I do play it quite actively, and I have been waiting for this upside breakout for a long time. I just don't know if this is the week that it does it, but it is something to pay close attention to. Last thing I think we should look at. Whoops, I didn't want to go all the way through there. Let's take a real quick look at the S&P. The S&P, it's kind of stair stepping lower, and you can see we are in this like little down channel, and we are making this corrective move as August has weighed a little bit on the stock market, but we're still outside of this ascending wedge. We're pushing lower, and there could be a further correction going into this fall, which makes sense. I mean, if you look at the long-term weekly S&P chart, there's a lot of room for some downside here. Does that mean we're going to crash? No, no, not at all. But does that mean that we still have room to pull back before November? Absolutely. This is typically a very tough time of the year for stocks. The end of summer, going into the into the fall. Typically, the stock market is a little bit weighed down naturally before the Christmas rally that comes in November. So we could see some further downside in equities. 2400 is going to be a big level of support. This you can see the support zone that comes through here. It's all around 2400, 2380. That's all going to be pretty big, and that's still 40 to 60 points away, S&P points, before we hit that. So a lot of support down there, but that means there is some downside for those of you that are trading or tracking risk appetite and stocks. But again, this is the last real week of summer, guys. Be careful. Liquidity's poor. Not a lot of liquidity going on. Volume should pick up midweek as we start getting the ADP data. We get unemployment claims, and then we get non-farm payroll on Friday. But I hope you guys have a great week this week. Make sure that you're logged in and listening to our FACE webinar with Dale Pinkert, our esteemed host. He always has great guests lined up for you. It's a free webinar. It's every day at 6 a.m. Eastern. Or actually, I take that back. It is at 7 a.m. Eastern. And so make sure you're following us on Twitter and logged in and listening to that free webinar. That's an hour and a half every single day. And if you like this video, make sure that you click that little thumb button down there on YouTube. And that pushes us to continue to give you more videos, and make sure that you share this on social media, and make sure you subscribe to this YouTube channel. My name is Blake Morrow. I'm with ForexAnalytix. Thank you guys and gals for listening in this week, and we'll see you next week. Have a wonderful trading week. Thank you.